Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is April 26th, 2020 edition of Market Outlook. And of course, this week we'll continue to do the combined video to allow everyone to have the benefit of this analysis. All right, hope everyone's staying safe. Let's take a look at the charts. First thing to note is both the S&P and the NASDAQ closed above important moving averages. Now, the S&P still under the 200, but closed above the 50 and above the 10-day moving average on Friday. So good close on Friday's action. The other thing you can see here is that our real motion indicator also is working in alignment with price action, so no divergence. The other thing is the NASDAQ 100 closed very strong for the week. Not quite as strong as last week, but still overall pretty good. Now, one thing to note is even though we closed in a bull phase, our real motion indicators are showing that it's starting to lose a bit of momentum. So, even with the great strength in NASDAQ 100, the momentum is sort of pausing here. So it'll be interesting to see how that plays out. Now, mitigating the S&P and the QQQs, sort of the divergence between the two, one thing that's interesting is that the Dow, right, which is in a bearish phase, actually has a divergence with momentum, or our real motion indicator, and that's a positive, because one thing you can see on Friday, we closed above the 50-day of real motion. So that's a big improvement here, and obviously we sort of have this compression, and if we can get above this 50-day, one of the things that we're seeing is that it's very possible that we could at least get rallies back up to the 200-day moving average across the board here, or at least hit what I would call resistance level around 296 in the S&P. So there's the bigger picture on the key indices. Okay, now moving on to taking a look at volume patterns and overall performance, one thing you can see is that we're sort of in neutral territory regarding the volume, right? So accumulation days versus distribution, with the exception of the NASDAQ, it's pretty much neutral across the board. Now, in terms of the performance, what's really clear is year to date, NASDAQ is actually positive, right? So leading NASDAQ stocks driving this index, year to date change, neutral or slightly positive, where you got really pretty still strong negative performance across the other three indices. And that's also true on a 52-week basis. Now, what's interesting is the weakest index actually started gaining a little bit of strength on a relative basis, closing up for the week, with the other indices closed marginally down. And these days, right, marginal is 1 or 2% either way, with the type of volatility we're getting, where that 2% move can happen in a half hour or less. Now, one of the most important things to note is just how the sectors are moving around. And this week was, even with the S&P down about 1% or just above it, a couple of interesting things to note. Retail, even with all the bad news about, obviously, U.S. consumers having to stay home, not spending money, and some looming bankruptcies of some major retailers, actually closed up on the week. The other thing to note, right, is that utilities, safety plays, one of the worst performing sectors, down 3.7% for the week. That's a good sign. Now, The other thing is consumer discretionary spending basically outperformed by over 0.5%, even though it was down the overall index. So discretionary spending, and the other thing is look at retail. Look at the. I'm sorry, we covered retail, but semiconductors, healthcare, technology, all of these still outperforming the other indices. So net, some speculative sectors doing better on a relative basis, and the stuff that you would think would continue to be under pressure, such as retail, doing a bit better. So taking a look at the rotation in the sectors this week, risk on definitely is a factor here. How long that lasts, of course, is in question. And, even with all of this positive movement here on the sector basis, we're still seeing, right, we're under the 200-day moving average, and there's some major resistance around that 296 to 300 level in the S&P. Okay, moving on to market hotspots, I just want to highlight the areas or the sectors that have really outperformed or lagged. So a couple of things. Gold miners, we highlighted that last week. It broke out, and you can see this week we really followed through, and over a longer term basis doing extremely well. Now, the other thing to note is biotech, also one of our 6-month leaders, acted well for the week, up 1.24%. Those are the two biggest highlights for the week in terms of sectors or particular asset classes. Okay, so one thing is taking a look at the risk gauges. Before we get too excited about the fact that some of the sector rotation was pretty positive, look what happened here, right? 1 week ago, or last week, we were at 100% positive in our risk gauges, and we backed off here. And one of the reasons why we backed off, let's take a look at some of the key ratios here of our key intermarket relationships. And so one of the things that is concerning is that high yield debt versus TLTs actually flipped negative. So the one thing that has been certainly highlighting the problems even before, right? One of the things that occurred when we got out of the market early in certainly the some of our quant-based models was based on the fact that high yield debt was definitely underperforming, even as the market was going up, the safety of bonds. So that's important to note. The other thing is that inflationary pressures, considering all the money that's being pumped in, started to wane versus gold. So gold performed decently, but lumber and housing under pressure. So net, we've got deflationary pressures here, and of course GLD, which operates certainly in a positive fashion when there's lots of money or inflationary pressures kick in, or geopolitical stress. So at the moment, we've got these two intermarket relationships under pressure. So that's mitigating that sector rotation, giving sort of a mixed picture. But don't forget, we're coming off 100% bullish, and we're still 60% overall positive. So we're going to keep an eye on it. And of course, the big picture overhead is high yield debt, and even investment grade debt is under lots of pressure, and we need to monitor that very carefully. Now, the next thing we're going to focus on is looking at style investing. When we talk about style, we're talking about themes by market cap and valuation. So one of the things that is a positive, flipping back again to the other side of the coin, is that our real motion indicator is running ahead. We're clearing the 50-day of real motion, and that is running ahead of the Dow, which is now under the 50-day moving average in terms of price. So if we can clear above this 50-day moving average on the price chart here, that would be a positive sign and probably help a market rally. So big cap stocks that have been under pressure, definitely looking potentially poised to move higher, but we need the confirmation of price. But momentum is telling us that if we do get it, it could continue. So there we have it. That's a big theme. The other thing to note is IWM, which is clearly the one in the doghouse. Basically, you're in this bit of a compression zone, and even though we're still a decent distance away from this sharply declining 50-day moving average, in terms of momentum, we're definitely almost on the cusp of breaking out on the 50-day of real motion and starting to potentially even gain on relative price strength versus the S&P, but not quite there. If we can get these two things, the Dow and the IWM, to improve, then that would be certainly a positive sign that we can get at least a 5 or a 6% rally to test overhead resistance and the 200-day moving averages on these key indices. Another thing to note, moving on to investment themes in terms of value stocks versus growth. You can see here VUG, this is the Vanguard Growth ETF, closed above the 200-day moving average. If you compare that to the S&P on our ratio here, you can see that growth stocks really outperforming. On the other hand, you would think the safety of value would be attractive during this period. Not the case. It looked like it might have been doing that about a week ago, but it basically reversed, and growth stocks continue to lead value stocks. And as you can see, we are in a bear phase in our real motion indicator. We're underperforming the S&P and still, a distance from the underlying price action on the 50-day moving average. We're nicely under it. So, quite a difference here between value and growth. Okay, now the other thing to note, let's take a look at some sectors because there's some interesting things going on there as well. So we had mentioned in our text here that the XRT, one of the things, right, retail should be under pressure, but you can see here that our triple play indicator, which looks at the a particular sector versus the equity ETF benchmark, actually improving. The other thing to note is we are trading under the 50-day moving average, but our real motion closed above it. So it's showing that momentum is definitely improving on a relative basis. And also, we're getting a nice little pop on pure price. This is a positive. So there you have it. Now, the other thing to note is taking a look at, let's take a look at IBB. This is biotech. And one thing that's clear is biotech is definitely catching a bid, looks really strong. So relative performance, volume, momentum, all looking good. nice compression here on this chart, and this is definitely very strong and leading. So our TSI, Trend Strength Indicator, is very strong. It's a positive 7. We're trading above all the key moving averages, right? And of course, the other thing is the semiconductors in terms of performance looking pretty good, although momentum a bit iffy. So its relative strength in terms of looking at this overall is not quite the strength of biotech at the moment. So that is leading here for sure. Okay, now moving on to gold. This is sort of interesting. I mean, obviously gold really strong. Gold miners looking really powerful. Sort of been highlighting that. We had some really good action overall this week, right? You can see good price movement, and we're basically closed at recent highs here. Now, what is interesting is, right, if you take a look, you've got a situation where this is our real motion gauge looking at momentum, which is a derivative of price, right? We hit a high here, another high on an intraday and even closing basis. IWM, the real motion, not able to really make yet another new high. And take a look at this. We got clearly another new high up in here and really having a tough time in terms of our momentum to really pull out and get much higher. Now, what's most interesting and is the fact that we closed on basically new highs or close to new highs on Friday and for the week, and yet we haven't been able to penetrate that on real motion. So the other thing is, even with the good overall performance, you can see TSI is a plus 6.95. That's really strong. However, on a relative basis, we're barely outperforming or slightly underperforming the S&P, which has been on a decent rally. So what we don't want is for real motion to take out this swing low. And if that it could mean that we got a little bit ahead of ourselves in GLD. Now, remember, we need that to actually occur, because what I'm seeing is that gold miners really strong, way outperforming gold after that nasty decline. But gold miners really strong, and this could just be a pause in gold, and that the leadership is being or the baton is being passed to gold miners. So overall, can't argue with this action, certainly compared to virtually any other asset class. But we have to be cautious here that we could be getting ahead of ourselves. So we're going to watch this carefully. We certainly don't want to see this swing low right here being taken out. But of course, the lead indicator could be real motion, where this gold could actually, the real motion could break down before the underlying price here. So we're going to keep an eye on that. Now, before we leave, taking a look at USO, this is in deep doo-doo, right? You can see falling apart. And so big trouble here. This whole ETF looks like it could be reconstituted, and it's not necessarily even tracking West Texas Intermediate oil contract in the futures market, which has been really pummeled. Historic action, minus $37 a barrel on the spot closing price this week. So big problems. However, what I want to do is look at look at Exxon Mobil, because that seems even though it's in the oil patch, looks poised to be able to take advantage of the situation. So let's take a look at that before we call it quits for the week. Okay, so Exxon Mobil. Now, obviously, this is not just an oil play, pure oil. It's oil and gas exploration, and its fundamentals are actually pretty strong. It's got a cash position. It's not nearly leveraged like some of the other stuff out there that has really gotten killed. This is a strong company with a good overall balance sheet. Now, taking a look at the price action, look at our real motion. We've got the short term where the 50-day is the benchmark here and the 200-day. And one thing you can see, we're actually in a bull phase on the short term, and that's running well ahead of the price action here, right? Because you can see the 10-day under the 50-day, and we're basically paused right under the 50-day moving average. And it's almost looking like sort of a cup and saucer pattern off the lows. The other thing to note is on our real motion gauge, where the 200-day is the benchmark, and this is the 50-day moving average of real motion, we're already above it. So if we can get any movement above this level here, you could get a nice pop, and you can certainly see that the price action here and the momentum doing well. Now, furthermore, even with the oil patch in deep trouble, look at Exxon on a shorter term basis relative to the S&P. And one thing you can see is we've got a positive divergence here, or a positive reading where we're trading above the monthly ratio. So Exxon Mobil definitely doing better than the S&P. Its momentum is pretty good, and it's poised just under the 50-day moving average. So if we can clear that, we could get a nice pop, and maybe that's telling us a little bit something about the oil patch as well. But nonetheless, this company, solid fundamentals, solid balance sheet, price action, definitely looking a bit better if you look at it based on our real motion and relative performance. That's it for now. Hope this all helps. And remember, make sure no matter what, you've got stops in place. You want to make sure that you're here to trade and live another day, and not, and not trade without risk control. Okay, stay safe and see you next week.